Hello traders, how's it going? This is Rob Reinhold, and with me is Darren Fisher, and this is the Maverick Trading Trading Room for the third week of December. This is monthly options expiration week, and really after this week, the real trading kind of goes away. Now look, there's going to be trading the last 2 weeks of the year. We'll talk about that, but for the most part, this is the last big week, and it is a really, really big week. There is so much on the table this week. I think this week is going to be one of the biggest weeks of the year. But let's start off with what happened last week. So last week we had a down week, 4 out of 5 down days. And we actually had a really nasty close on Friday. So we closed down at really big support levels. As we said last week, we feel like we are on the edge of either a breakout or a breakdown. And we didn't think we'd get it until next week's CPI report. Sure enough, we got some pretty choppy action this week, but really nothing definitive as far as a longer-term trend goes. Some positive news, we did get some relaxation from the curbs that the Chinese government had been putting in for the COVID crisis. We saw lots of markets in that area of the world actually do quite well this week. This week, the U.S. market actually did the worst. And if you want to take a look at the worst market, oil. Oil has plunged down to the low 70s. It's not just lower today than where it was when the Ukraine war started. It's lower than it was when the year started. We're back down to December 2021. Darren, what do you think about this move in oil?
It's a little bit puzzling to me, but I mean, it just reflects the supply and demand. I think this is more indicative of, I think this is a leading indicator that we're really facing a serious recession. For the demand for oil to go down that much, we've already priced in Ukraine, we already priced in a bunch of other things. For demand of oil to go down that much, I think this is one of those leading indicators that energy consumption is really going down, and we've got to take a look. How serious is the recession? We've already had 2 negative GDP quarters. That used to be the rule of thumb. That's a recession. How bad is it going to get, though? I think that's what we have to take a look at.
You know, Darren, the strange thing is that the projections for the fourth quarter GDP are around 3.5%. So, yeah, we had those 2 negative quarters, but we've somehow bounced back. And I actually think the Fed is in a pretty tough spot here. Let's take a look at just some of the economic numbers. And I kind of want to walk people through the bind that the Fed is in. On Monday, we got the ISM Services PMI. Now, this is about 2/3 of the U.S. economy. It's a big deal, and it was way stronger than expected. Remember, we've been talking about this for months. Good news is bad news, and bad news is good news. This strong number sent the market tumbling. Monday was a big down day, and it was because people are worried that the Fed is now going to start raising interest rates even more aggressively. And then take a look on Friday, we got the PPI, and that is a bad number. That's a very bad number. The market did not want to see this. And right off of the news, the market plunged about 1.5%. And then the market opened up and it recovered. Now, most of the day, the markets were flirting in the positive territory. And I was thinking to myself, okay, this is a sign. When bad news comes out and something goes up, it's a sign that it's not going to go down anymore. And if we actually would have closed at the top of the range on Friday, I probably would have gone into this week a little bit more bullish, but we got a nasty, nasty sell-off at the close at our lows, close at really key support levels. And now we're seeing that the Fed is in a bind. We've got this leading indicators, Darren said, oil just plummeting, really showing, okay, there could be some serious demand risk out there with slowing economy. But then on the other hand, we have rising ISM services, rising PPI. This week is going to be very interesting because this week we have the Fed meeting on Wednesday and we have the CPI report on Tuesday. Now, let's put all of that aside. That's a lot of what we call cocktail talk at Maverick. We're going to talk about it. We love to talk about it. But cocktail talk means it's best talking about this with a drink in your hand with your buddies. It's not what we trade off. We trade off of the charts. This week was not a great week. Dow down 2.7%, S&P down 3.3%. This was the worst week since September. The NASDAQ down 3.5%, small caps down 5%. Oil got crushed. Let's take a look at these charts. Now, I want to take you back to last week. Last week we had a chart up, I'm going to throw it up right now, of a longer term chart, and we had come all the way up to that long-term trend line. And at that point, we said, look, we don't know what's going to happen here. It's likely going to hit this. If it can't break through it, we're likely looking at another leg down over the next month or two. If somehow we can break through it, we might see some more bullishness, but we don't know, and we don't expect to know until after the CPI report. If you take a look specifically at these last 3 days, we had this big pullback, about a 4% pullback, and the bounce was lousy. That was a lousy bounce on Thursday, Friday. Not very inspiring at all. We come over here to the NASDAQ, same thing, a lousy bounce. However, you have to say, though, that it has not broken support. The NASDAQ has not broken support, and the S&P has not broken through support. Now, that's about all that you can say positively, is that they haven't broken support. We will see what happens, and Tuesday is the day. I expect Monday to be a pretty quiet day, and then Tuesday, we are either going to break below this 280 on the Qs, and that is the signal that we are most likely going to retest lows, at least retest, if not make new lows. Now, the reason why it would plunge below 280 would be a hotter than expected CPI report. That would be the catalyst, but the chart is the chart. Once this 280 is broken, and once the 50-day moving average is broken, we are now going to shift to more bearish here. If for some reason that could happen, the CPI is a good number, then I think you have to look back to the recent highs as pretty much the highest we can go until we prove that we can break up above that. At this point, I can't say which one is likely to happen. All I can say is I'm prepared for both, and I will make adjustments for both. We take a look at the VIX has popped back up, showing that people are getting a little bit more worried going into this report, getting a little bit more hedged. Darren, I truly see this as I'm not ready to stick my neck out until I get more information. Do you have anything to add to that?
No, you're in the same situation. I'm in the same situation. The fund managers are in the same situation. Nobody wants to try to be a hero, one or the other, between now and the end of the year. Anyone who's running a significant amount of money right now is in career preservation mode. That's all. That's the best they're looking for right here. So, yeah, I think Tuesday is going to be the big day, and we'll see which way we go. People are hoping for a bounce up, but it's one of those ones. I think if you take a look at what the numbers are doing, I think it's a 50-50. Actually, I'm going to say it's 60-40 that we break lower. That's how I think this number is going to come out. It's 60-40 that we break lower.
I like those numbers because when I said I'm 50-50, I'm like, I'm a little bit more to the bearish side, but not much more. But look, here's what I can say. We truly are in this point where, okay, you can't stick your neck out. By next Friday, I will be very clear. Unless we haven't broken out of this range somehow, I don't see that as being possible. But by next Friday, we are going to know, hey, we are looking at another leg lower, or we just broke through that long-term trend line to the upside, and this market actually has some more bullishness left in it. We will know by next Friday, and we will absolutely share that with you. So let's take a look at the calendar. Let's just jump to the calendar. We expect to see a very flat Monday, and then all of a sudden, we're going to have fireworks really all week long. The CPI is due at 8:30 a.m. Eastern Time. They're looking for a 0.3. Even a 0.4 would scare the market a little bit, but 0.3 or lower would be good news for the market. 0.3 to 0.4 would be neutral to the market. 0.5 would be disastrous to the market, and you would definitely see a very big move down, potentially like a 3 to 4% down move. Then we hear from the Fed. The next day we hear from the Fed. We have the press conference with Chairman Powell. This is going to be another big market mover. Are they really going to pause? They've hinted that they are looking at possibly pausing. We get to hear from them again, but this is an official statement, and this is going to cement what the market believes the Fed is likely to do in the next couple months, which is really going to matter to the market. After that, on Thursday, we've got retail sales. And that really is just going to be the momentum from those two reports that just keep this market moving. I expect there to be a potentially 5+% move either direction this week. Darren, do you think that's too big of a projection?
No, I really don't. I mean, that's the higher end of what we've been looking at. No, I can't say that. If you'd have talked to me any year but this year, I just said that's, you're on the right side of the bell curve on this one. With this year, I think that's totally in line. You might be one standard deviation to the right, but the moves that we've been having this whole year, 5% one way or the other would not surprise me.
So let's jump into our market scoring system. Now, everything that we just kind of talked about, again, that's my opinion, that's cocktail talk. This is a definitive, this is not my opinion. This is where is the market on a technical basis. The market is trading below the 20-day moving average, which is a -1. It's above the 50-day moving average, which is a +1. And the slope of the 20 and 50-day moving average has changed. The slope of the 20 is now flat. It is no longer higher. So that becomes a neutral. So the monthly outlook is truly at a neutral. So it's really interesting how these things match up. Darren and I are both like, hey, we think there's going to be a 60-40 chance one way or the other. When we take a look at the technicals, and this is what you always want in your trading, your technicals should match your opinion. Now look, your opinion is your educated guess, and all traders are going to have different opinions on things. Here is the difference. Here's how to check to see if your opinion is actually right. Do the technicals match up with it? If the answer is no, you're probably wrong. You probably have let some bias into your opinion to cause you to think differently because the market's showing you is different. I love that the market is giving us a 0 here, not showing us any clear direction. So I think we just have to sit, be neutral at the point, and then make a reaction once we do get the break. Let's take a look at things sector by sector.
Yeah, we definitely had some movement in the sectors, and it was kind of surprising which way they went. I mean, take a look at it here. Utilities did the best. It was only down 1/4% right there. And you can see energy just got pummeled. I mean, with the price of oil down over 10%, the whole energy sector was down, 8.5. I mean, that's a huge move. But this is something in the past, 3 or 4 months we've come to expect from energy. Big moves one way or the other. So taking those two outliers out, I mean, you can see it was not looking good across the board. Communication services and consumer, they performed, -2. I mean, you can see they're both down over 4%. And everything else, down, 3.5. Real estate and healthcare, surprisingly, are the ones that held in there. Healthcare has been really strong lately. It's been strong for a while, actually. And real estate, did a little bit worse than utilities, but not too much. Let's get into the individual sectors right here. You can see utilities really didn't go a whole lot. I mean, I was at a +2 last week in utilities. I'm still at a +2. I mean, it was a 0 week essentially for utilities, but we're still looking pretty good. Above the 20, above the 50, very, very narrow range right there. This is just people playing the wait and see game, and that's fine with me. Any trades I'm going to put on utilities, I'm probably going to have at least a 6-week time till expiry, and I'm fine. You want to take a 1-week break, in utilities, that's fine with me. Looking pretty good at a +2. Communication services last week, they actually had got into my good books and got a +1. They're back at the 0 camp right now. You can see it's pinned between the 20 and the 50. Tuesday, just an ugly, ugly day right there. And Wednesday, Thursday, Friday, just sat there right at the 50-period moving average. And, it's just going to be right there. I'll give you a 0. Show me which way you're going to go. I think this one, if this is one of those ones where if the market breaks to the upside, communication services lags. If the market breaks to the downside, communication services leads the charge downward. This has been weak for the entire year, and this is one of those ones where if the market breaks down and there's no support, this one is going to be one of the ones where people are just bailing on. So just keep that in mind. Looking at real estate, I was at a +2 last week. I'm at a +1 this week. I mean, it's trading right at that 20-period moving average. Still a very narrow range. Not as much movement on that Tuesday breakdown that a lot of other things had. So it's just hanging out right here at the 20 period. I'm mildly bullish on real estate. It didn't come down as much as a lot of other things did. So this is one of the ones where you can take a look. Just don't expect Herculean efforts from anything that you do in the real estate sector. Industrials was at a +3 last week. I'm at a +2 this week. Okay, we just barely broke below that 20 period moving average right there. You still got a nice wide gap between the 20 and the 50 moving averages right there. We're well above the 50, just not quite as bullish. I mean, in all, if you take a look at the past month, we're kind of flat. We're at resistance right here, or excuse me, we're at support right here. So we'll see where we go from here. Utilities still looking pretty good at a +2. Healthcare was at a +3 last week and still at a +3. Even though Friday was an ugly day for healthcare, firmly above the 20 and the 50 right there. The slope is great on both of them. We might have some resistance there at 140, but you can see it's looking pretty good. It's looking really good right now. A lot of strength in healthcare. This is one of the ones. This is the only one that I'm still a +3 on, but this is going to be one of the ones where if the market breaks to the upside, this is going to be the one that leads it. Looking at financials, this one came down a lot more than I thought it would have. Was at a +2 last week, and now I'm, this is firmly in the zero camp, almost directly between the 20 and the 50 period. You can see Monday was the bad day for financials right there. Tuesday didn't look a heck of a lot better, but it did stabilize at some, right there at support, about that 34.50 mark. But that's kind of weak support. You go back about a month, and that's where it is. There's only two, places right there where it's showing support. That's not a lot of data points for people to go on, and you had that nice gap up. So you filled what was the gap from about a month ago. You filled that right now. This one could potentially tumble if we go down. This is going to be one of those ones that if the market goes up, even if we have one of those 5% up weeks, if we're expecting that, I would not expect financials to perform as well. That'd be one of those ones that maybe is up 2.5%, maybe 3% for the week if we have that up 5% week. That's a possibility right there. So this is going to lag, I think, anything to the upside. Consumer, we were at a +1 last week, and we just had to go to a -1 right now. We're, you could make me the case, well, this should be -2. Just the price action wasn't deep enough for me. We're at some support. This is about 4 or 5 data points we've had right here. So we're at support right there. We'll see which way we go. This is going to be one. Consumer has been shaky. It's been weak for a while now. And so we'll see which way it goes. This is another one. If the market goes to the upside, that 5%, again, this is going to follow financials. I think you might eke out 2, maybe 3% of the upside. If the market's down 5%, in general, this one could be down 6, 7%. That's just how weak the action has been lately. In tech, I'm at a firm 0 on tech right here. It's just pinned between those moving averages. Made up a little bit of its gain from Wednesday. Not a whole lot right there. I mean, that was some short-term support right there. So we'll just see which way it goes. I want to see which way the market breaks before I'm going to get either bullish or bearish on tech. Basic materials, we're at a +2 last week. We're at a +1 this week. Okay, it just that Friday's candle, to me, put it in. We've got some definite weakness. You can see right there, closed at the lows. There's no bounce back right here. It's got a little bit of room till it finds support. You can see those levels about the 70, 79 area. Just above 80 as well. So it's definitely got some support right there. I'm just less bullish on this than I was about a week ago. And finally, energy. Back into the -1 territory. You don't see this very often. We haven't seen it very often throughout the entire year, but you can see absolutely no recovery. Monday was a horrid day, and it just kept getting worse all week. Closed on its lows for the week right now. So if this continues, if it continues to stay below that 50-period moving average for the next week, this could rapidly devolve into a -2. Right now, it's just a -1 for me. We'll see if it bounces back. The energy's been one of those ones that has been surprising. So you can see on the negative side, consumer and energy, those are the only two. I mean, despite all the action the market had this week to the downside, these are the only two that are in negative territory technically for us. Technology and communication services are at 0. Want to see which way those go. Financials, materials, and real estate, mildly bullish at a +1. Industrials and utilities looking pretty good at a +2. Healthcare is the only one that's the strongest sector right now that I'd be looking at. We're at a +3 on healthcare right there. So let's take a look at some potential trades. Okay, last week we were sideways to long in CNP right there, and it was down 0.72. But you can see from the chart, it just pulled back to the 20-period moving average. Right there. I mean, we're looking pretty good. I mean, this trade's got another week or so on it right there. We'll see if it bounces back, but this is one of the one of the stocks that held up better than a lot of other ones. So I'm actually not worried about this one. This week we're looking at Simon Property Group. So ticker for that is SPG. This is in a nice high base right here. You can see, I mean, it's looking really good. It held up really, really nice. So a couple of different ways to play it. We're just in this base between 115 and 120. So what we're taking a look at is going long those January 115s and then shorting this Friday's 120s against it. So if it holds up anywhere in between 115 and 120, we're looking pretty good. And the ideal would be to close just below 120. We'll just give it some time. You can reevaluate next week and see if you want to keep this. But this is one of those ones. It looks pretty good, especially the last week before options expiration. Communication services. Last week we were short Vodafone, and symbol for that is VOD. And you can see this performed very, very nice for us. This was down almost 6%, 5.96%. And this one's got a little bit more time. It might have hit a little bit of support at 10, but you can see this thing is, it just wants to keep going lower. Happy to stay in this trade and let it play out a little bit more for us. This week we're looking at Comcast, and these are the A shares, so the symbol is CMCSA. Nice bull pullback right there. Despite the market action, this bottomed on Wednesday, had a good candle on Thursday, and a good candle on Friday. I mean, really typical classic bull pullback to a moving average. This is looking pretty good. So which way do we want to do this? You'd either go out all the way to January and say, hey, I'm just going to play this directionally, 35.40 bull call, or you can get a little bit sneakier right there and go long those January 6th 32s and then short this Friday's 36s against it. That'd probably be, that'd give you a little bit of time to see which way it goes. If I was to do this, I'd probably actually just go entirely. I'd wait until after Tuesday, and then I'd probably just do the bull call spread on it once I see where things end up. In healthcare, last week we were long intuitive surgical, not interactive surgical. You don't want to be doing surgery on yourself right there. So we're long intuitive surgical. This one actually, despite the good candles, it was down 0.6%. Most of that action came on Friday right there. Thursday looked pretty good. So we're in this trade for another couple of weeks. This is looking pretty good. I have no reason to want to get out of this. I mean, what was resistance is now support right here. Any upward market action, I think, looks pretty good. This week we're looking at Amgen to the long side, a little bit of high base. And you can see that was a pretty ugly candle on Friday right there. So I'm going to want definite confirmation. I mean, pull back to support right there. Before I get into this, I definitely want to trigger. I want to see a higher high and a higher low. That might take me till Wednesday to get. That's fine. No reason to get into this early. A couple of different things you can do. Once you do get that trigger, you go long those January 6th 270s, and then you short this Friday's 280s against it. Pretty good place to be right there. We're not expecting a whole lot. Just hold in there. Right at that 280 level. If you want to play it a little more conservatively, I'd say just go out to January and do the 280, 290 right there. But I think I'm liking the diagonal on this one. I just do want that confirmation to make sure we can erase that candle from Friday.
Let's jump over to industrials. Now, this was my favorite sector, and it's been my favorite sector for about the last 3 to 4 weeks. And I got to say, I've definitely cooled on it as the technicals have come down. I really feel like this sector got a big boost because the overseas markets have been doing much better than the U.S. markets. And over half of the industrials revenue is generated overseas. So this really does benefit when overall markets do better. I think that if we do get a bad reading in the CPI, If the dollar shoots back up, it is very negative for international stocks. And this is really going to hurt industrials. So I'm definitely backing off of my bullish stance on industrials. Last week, we talked about Caterpillar, and Caterpillar is just sitting here in this high base. We had a diagonal call spread on Caterpillar. It's got one more week left. However, it's trading at the bottom of the range. So if we break down below this range, we do want to take our loss and jump out because it just hasn't done what we wanted it to do. We thought it was going to be sticking in this range between 227 and 240. Once it stops doing that, we'll bail and move on. If it holds in this area, it's perfectly fine and the trade will work out nicely. This week, we're looking at a short, Plug Power. What we wanted to do is find something that hadn't really benefited. This is the epitome of not benefiting. Industrials are up very nicely since the low in October. This thing is dead. This thing is absolutely dead. So as you can see here, we've got 3 candles here. We just broke down below this last low, and we got no bounce whatsoever. Looks like this thing wants to go lower. The only question is how to play it. I really like diagonal call and put spreads on a 1-week basis to give me 1 week to test drive the position. What I want to do is I want to go out to the January 20th, 15, and I'll sell the 13. Now again, this is very, very wimpy for the first week. I'm going to collect that premium on the 13. I'm going to check out what happens with the market. If the market bounces up, I'm probably going to look to keep this one 5 days and 5 days only, and then move out of it. However, if the market does break down, and if it doesn't go too far this week, I have the ability to either let that 13 put expire or buy it back. And now I'm just holding straight puts. And this thing to me looks like it wants to go down to the 10 area. That's about a 33% drop. That would be really nice to get in long puts. So diagonal call spreads and diagonal put spreads really give you the ability to extend the trade if you're getting the kind of price action you like. Let's move next to financials. Last week we had Charles Schwab on a breakout, and you can see kind of the same thing that Caterpillar did. We also had this one on a diagonal call spread. And as long as it holds above this 80, we are perfectly fine. The problem is if it doesn't hold above 80, we don't want anything to do with this. We want to bail on it and bail fairly quickly. So this one could be a trade that is exited on Monday or Tuesday, and that's fine. Exit for a loss, take your loss, move on to the next one. If we do bounce back up, this trade is going to work out just fine. We'll have to wait and see what happens on this. This week, we're looking at a short in PayPal, bear rally. We had just broken below. We did bounce off this little low here, but you can see these bounces are getting progressively less and less. Turning over here, looking at a 70-75 bear call spread. This one's going to need to fall. We are making a call on Delta here, saying, hey, we think this is going to go below 70. And that's all we need. We need this to go below 70, stay there, and this is going to be a max gain on the trade.
Yeah, last week in consumer, we were short CHPT right there. I think that's a Checkpoint is the actual name of it. And this thing did really nicely for us. This was down 8.5%. I mean, you can see when you get down there, barely in the double digits right now. I mean, it wants to go even lower right there. I mean, any support it had at 11 firmly broke through on Friday right there. So we're just waiting to see. Let this thing run to conclusion and take our gains after it's done. Right now, we're looking at in consumer. We're looking at Kellogg's. So this is consumer staple right here. You know, anything that's cereal that people have to buy repeatedly. We're going to take a nice look at it right here. You can see it just wants to be in this range. You know, 72 at the low end, probably 74 at the high end right there. Or you could take it out even more. You know, go up to like the 76.50 area, 69.50, right in the middle of the range. So best way to play something in a range like that: 69, 72, 75. Call butterfly. You know, 72 being the midpoint right there. You know, anything between I'd say 70 and 75 is probably going to be in your profit area right there. So, you know, just take a look and see which way that one goes. But this one's looking good for a nice sideways trade. In technology, last week we were long Dell, and this is one that did not perform for us. This simply, tech was weak, and it definitely rolled over, went below that 20-period moving average. If you haven't gotten out of this is one that would be on my short list of things to get out of. It was down at 6%. And something like that, your thesis doesn't pan out, just preserve your capital. If you make sure you got to go into the trade with an exit strategy and go and let it run. This is one that I would be looking at to just exit out of, unless the market tells me otherwise on Tuesday. But this is one that did not perform for us. This week we're looking at Coinbase, COIN. This is in a low base, and you can see we kind of broke through on support right there. This is a bad day. This is one of the few times that I would actually say 45 puts, unhedged puts, would be the way to go on this. Here's the reason why. The volatility is low. The VIX is low. It started to creep back up. But this is one of those times, if you get something that's breaking down, the volatility is low, you're not paying a lot for volatility in the option itself. When the volatility is very high, something like straight puts, it's very difficult to make money on. When volatility is low and you find something going down, I would definitely say this is the market condition that you want to be on the upside, because if volatility continues to increase, not only do you make money in the delta as this goes down, you're also making money on Vega, on volatility, as the volatility goes up. So you get a twofer on something like this.
And Darren, I totally agree that long puts make sense here. If you remember back in early October, when the market had already been down and volatility was high, we said, hey, no long puts here. It makes no sense. You're paying too much for volatility. This is the exact opposite, where if we do roll over on Tuesday, I think long puts are priced really nicely here. I think that's a good strategy. In materials, this is a +1 sector. Last week we had AU. This is a gold miner, and we had another diagonal call spread, and it was basically flat. It was down under 1%. So this one looks really nice. As long as it holds this 18, this is going to be a really nice trade. We'll have to wait and see if it holds 18, but if it just holds in this range, we'll be very happy with the results on a diagonal spread. This week we're looking at DuPont. Same thing here, high base. It's holding up nicely. We're not asking this thing to go significantly higher. What we're saying is don't go significantly lower. This 70 point is a really short-term target to where we can use this diagonal call spread strategy to basically say, hey, give us 1 week where we'll do this diagonal call spread strategy. 70 is going to be the max gain point. If it really tanks, we want to get out of it. But as long as it stays up in this area, we are very, very happy. It's all profitability in here. It's all profits somewhere above like the 68 area. And if it does take off and run, if the market breaks out, then guess what? We're still going to have a profit. Maybe not as much as we had at 70, but it's still going to be a nice profit. Then on Friday, you can reevaluate the whole thing. Do you want to hold the January 20th 65 calls over the next couple weeks? If the answer is yes, you hold them. If the answer is no, you sell them and you move on to the next trade. As you can see, all of our trades on the bull side are really like a +1. We're a little bit more aggressive on the bear side here. Moving into energy, we had a short last week in Vermilion Energy, VET, and you can see big 5 red candles. That's exactly what you love to see when you are short in a stock. And again, we've got the 1820 bear call spread. If this thing has a huge bounce next week, okay, maybe we don't get to book our max gain, but it's looking really good here at this point. Down 11.5% for the week. So nice call on VET. This week, we're looking for a short in Petrobras, PBR. Bear rally pattern off of that low just below 10. This is what we really like. We love bear rallies because it's a weak stock. And take a look at this. This thing went from about $9.80 up to almost $12. That is about a 20% bounce. There's some nice, fat, juicy return if this thing just comes back down to the 10 area. Now, I want to take a look at the diagonal put spread again because I think this thing could have some more downside. If energy goes any lower and oil goes lower, then this thing could easily make a new low. So short term, I want to do a 1 week trade. The January 20th 1250 put. I'll sell December 16th 1050 put. Pretty much right at the money here. Diagonal put spread. Here's the risk graph. 1050 is going to be our price. We just don't need this thing to really run to the upside. As long as it hangs out down here, we are very, very happy on the trade, and it will be a profitable trade. That brings us to the end of our trade section. Maverick traders, go onto our forum. Share your trades with all the other traders. We've had a lot of great activity lately, so let's keep it up. Share trades, help everyone make some profits. Let's go ahead and wrap this up. I think by the end of this week, you will hear both Darren and I say clearly, okay, the next major move, the next major wave is to the upside or the downside. I'm right with you, Darren, 60-40. I think there's a little bit greater chance of the downside. The only thing that is making me hesitate is that everyone's expecting a break to the downside. And all of a sudden, that makes me think, okay, maybe there's too much pessimism at this point. Maybe the worst thing that could happen to the market is that it rips higher and it catches a lot of people with their pants down. A lot of times, that's what happens in the market when things get too overweighted on one side. What do you think about that, Darren? Do you think there's too much pessimism out there?
I mean, that follows the theory of what the market's going to do what hurts the most people. It's what I think this is one of those ones where if you see which track the freight train is on, you just need to either get on the train or get out of the way. You know, even if everyone's expecting it to be on one track or the other, there's going to be momentum behind that. So this is one of those ones where I think once the market makes a clear decision, are we going to break out or are we going to break down? That's the train to get on. I wouldn't look for a head fake on it. We're too late to the end of the year for that to happen. That's my opinion.
No, that's a good call for sure. Thanks for joining us. Everyone have a great weekend. Goodbye.
Good trade, everyone.